Welcome to Bullshift the podcast, where we talk about personal finance as it pertains to ordinary investors with a special viewpoint on behavioral issues and things that people might not always think about with regard to personal finance. I'm John DeGuy, the author of the book Bullshift and the host of the podcast. Thank you for joining. My guest this week is Som Seif. Som is the founder and chief executive officer of Purpose, which he formed following the sale of Claymore Investments to BlackRock back in 2012. He was also the co-founder of Wealthsimple, and prior to Claymore, he was an investment banker at RBC Capital Markets. Som has a strong commitment to the community and is currently a member of the AGO Foundation Board, Next Canada Board, and U of T Pre-Campaign Committee, and the Mechanical Industrial Engineering Advisory Committee. So he does a lot of things above and beyond being a finance guy. Som, thank you so much for joining me today.
John, it's always a pleasure to see you and spend time together.
Great. We're going to, as you probably know, we're talking in this podcast about behavioral finance and about the sorts of things that people maybe don't always think about in terms of their little quirks and their biases that are oftentimes unconscious. With regard to you, you're still a young man, but you're already a wily veteran in the Canadian ETF space. So what would you say are the biggest developments we've seen in, let's say, exchange-traded funds over the past decade or so?
Oh, wow. Well, I mean, it's been amazing to see, the world of ETFs kind of change, but also just like the psyche of the markets. When I started my first company, Claymore, back in 2005, people used to say EFTs, what are they? And so I remember we walked into advisor offices and to, go, speak at events in front of clients. And at that time, you'd ask the question, how many people would, be using ETFs or would be familiar with ETFs? And, 1 out of every 10 people would say they do already use ETFs or know about them. And it was quite an amazing period where you were trying to tell the story of, this industry. And of course, at that point, I think before I launched, there were 14 I units, not even I shares yet, units in Canada. And for everyone who knows that Canada was actually the first market to really develop the first ETF on the TIPS product, the TSX 60, or it was the primary index market product back then, and still it was only a very small marketplace. But what you saw, and I saw at the time, was one that there was a real need for innovation within the asset management space. 2 was that there was a growing focus on structure of how they access investment products. And then finally was the focus on fees and transparency and tax and all these other things that were really becoming relevant, and not only for retail but for institutions and for all investors. And so we saw this really important need, and the ETF structure was a really important structure to help grow. And so, we as a firm were the first firm that really came in back then and started to focus on things that were non-traditional ways to, invest in the markets in a passive way. So this idea of fundamental-based indexing and what I guess they call today smart beta, which I generally hate that term. And there wasn't at that point anything that was based on, anything other than just a traditional market index. What we've seen over the last 15, 17 years since then has been just a proliferation of growth of innovation, product solutions that have helped all investors, institutions, all the way to Mrs. Smith and putting $5,000 at work, get access to returns and return streams, get more precise ways to build portfolios, and very thoughtful investment theses in many cases. And we've also seen some crazy, stupid stuff, as we can always talk about. Say things that maybe play into some of the very things that you talk about, which is human biases and stuff in a wrong way. But it's a really positive. And of course, today, there are, thousands of ETFs in the Canadian marketplace. There are, tens of thousands or so, I think, multiples of that in the US marketplace and globally. And ETFs are now, ubiquitous. You would ask an advisor now or an investor today, do they use ETFs? And it's 10 out of 10. Every single person is using them. Every institution is using them. It's become, critical component of the way people manage their money and build portfolios and, create diversity in the way that they allocate their investment processes.
It's great because I think of you as a trailblazer, given that Claymore was the second company in Canada, and part of what Claymore did to move things forward is one, gave investors some choice that they otherwise might not have had because there was only one other game in town. But two, as you say, and you call the new company Purpose, but even before with Claymore, you're bringing different approaches. The again, poorly named smart beta. By the way, I have a joke that's smart is just an acronym. It's a silly moniker about rules-based trading is what SMART stands for. So I'm with you. I think that the term smart beta is a bit of a misnomer. But you've with Purpose, the thing that I would say is a huge hallmark of the company is that the things that you do are purposeful. They have a role to play. They are the sorts of products that are oftentimes used as great complements to improve risk-adjusted returns that other people might not otherwise think of. And so you're always thinking. You're always looking for new ways of doing things. And that's to your credit. I think it's really wonderful that we can have innovators out there that do these sorts of things.
Well, I appreciate that, John. And look, the way we've always approached this from the day, I naively started Claymore and as a young kid who just said, look, I thought the job to be done of an asset management firm was to go out and build products that would beat the markets. And that's because that's when I would look at ads and hear the industry talk about itself, all it did was talk about, hey, look at our products that beat the markets, and and that was the principal mindset. So as a mathematics and engineering guy, that's what I studied, and I come and said, what, like this can be engineered to beat the markets if you really want to, and so that's what led to the principles of the formation of it, which was very naive, which was, let's just go build investment products that help individuals beat the markets. And the way we did that was so indexing is a really powerful thing, and we know that. Why? Because it's low cost, it's easy to execute, it's non-human error prone, so it's rules based and such. And then the thing for me was that I just didn't like the traditional benchmark indexes. I always looked at the S&P TSX index and said, like, this is a silly index, right? I looked at some of these, indexes and just said, like, it's not actually the way, a great way to pose it. If I walk into a room and you were the investment committee and I said, hey, let me tell you about my investment process. And it is that every single time my stock portfolio goes up, I buy more of those stocks. And every single time stock portfolio goes down, I sell those stocks. And that's my investment process. And you would sort of look at me and say, that sounds a really stupid, approach, but that's what the index does every single day. And so I just didn't like that. And I love the fees. I love the execution. I love the fact that it had no human intervention and biases. But so that's what led to, let's go and really use more of a fundamental approach. Let's look at companies based on their footprint in the economy. What are their revenues? What are their dividends? What are their book values? What are their cash flows? Those are the things that actually, you can measure, and let's divorce it from the market price to some degree. And oftentimes, what that did was it actually looked at a company and said, look, is the stock price actually dislocated from its actual fundamental value? And you were able to kind of trade around that. But you still preserved a large part of the great things that indexing gave you. And that's what we did. And frankly, we built a really cool company at Claymore and did some really amazing products and advanced at that time. And I'm sure, I'm really excited to talk to you about some of the human biases and things like that actually played into why we then edited some of that thinking when we built Purpose. So.
Okay, so let's go there. Everyone's got biases, and the challenge, of course, is to recognize them and to mitigate them. And so I wanted to ask you about the way advisors and investors are biased. But if you can do an overlay to talk about how that actually was part of your thought process at your current firm or at your previous firm, I'd be delighted to hear that too. So off you go.
First off, I think we're all biased. We're humans, right? We're wired in a way. And there's so much beautiful research around behavioral science and behavioral economics that I've become a student of, and I know you have, and frankly, many people should be and are. It just wasn't as readily available 20 years ago. So, that's the other thing is I also believe that we have to be cognizant that from a perspective that, people are learning as we go. And so, 20 years ago, we didn't have the same richness of data on human biases and challenges. And so, and same with, on investment processes and factors in the markets and all that stuff, which have become much more prevalent today. And so, when you look at it, we're all biased. And I think more often than not, good investing is actually managing to counter your biases. I think you talk about this, John, and others, really expose this message, which is that, oftentimes what you need to do is actually try to, stop yourself from making bad decisions, because it's our own decisions that oftentimes create the bad outcomes. If you actually have a more disciplined approach, and that's where the word discipline, diversification, all these things are really important, is because it allows you to kind of try to counter some of the things that you are naturally going to do. The best thing that happened to me was in the later years of building Claymore, I had a partner. The partner was a firm called Guggenheim out of the United States. It was the Guggenheim family. They had a multifamily office. They managed money for many billionaires and wealthy individuals around the world. And I got, the opportunity to spend time with them on how they think and act on the advisory role of running money for a very wealthy family. And one of the things that they did really intelligently was they brought in a very well-known individual named Danny Kahneman to advise them and help them think about this problem. And Danny, of course, won the Nobel Prize for very much behavioral economics. And it's a great statistic. He for those who know him, and Amos Tversky created prospect theory, but the principle of it was around this idea that individuals have an asymmetric view of risk. And that means that they value a dollar of gain differently than they value a dollar of loss. And this is really, really important research, and how it transcends and embeds itself into the way that we as advisors, investors should be thinking is really critical. I'll give you a great example of that. If you look at the stock market actually has, has a lot of great attributes, but in itself, it has about 1 times return to about 2 times risk. So it actually is counter to the way most people think. So what that means is, and the average the average human has about 2 times to 1, which means that they can tolerate 2 times upside to 1 times downside. That's their it's not 1 to 1, it's 2 to 1, and so it's actually inversed on the stock market. And so what does that mean? It means that if you are an average human and you invest 100% of your portfolio in the stock market, you will likely have many instances over your tenure of being challenged, of being scared, of being nervous. You will likely have fears that will lead to, and if undisciplined and unchecked, to selling at the wrong time and buying at the wrong time, because you are wired in a way. And so that's why it's so critical that when you're managing portfolios, you think about these things, because 100% stock portfolio, yes, it's probably really exciting to be a part of, buying great companies and owning them forever, but can you own them forever is a real question, because will you, in an 2008 environment, in a 2020 pandemic environment, in a 2022 stock decline environment, will you be tested individually that you can't hold on and you sell just at the wrong time?
So it's ironic that you should say that. I just wanted to interrupt very quickly. I've actually got a graph of a prospect theory, that the 2-to-1 ratio that Kahneman and Tversky developed in Bullshift, to actually illustrate precisely the point that you're making. And that's exactly the concern that I have. Not necessarily, this is not a forecast, but if what we've seen in 2022 is the beginning of a drawdown, and many people are saying that there's a recession on the horizon, and that may or may not be the case. We'll see. I don't know. But if in fact that's the case, then it will be prospect theory in action, and people will be left with a situation where the drawdown may be more than they really contemplated. They hadn't really thought through how much they can actually tolerate. And I think that's where the rubber's going to hit the road. And the concern that I have in Bullshift is that people are overly optimistic. And I'm an optimist. I'm pretty sure you are. Most people that I know in the financial services industry are optimists. And optimism is a great bias to have. except that when things go really, really wrong, it can be dangerous. I've got a little story that I wanted to tell you, and then I'll let you just finish your thought. I don't know if you know who James Stockdale is, but he was
I know the name.
okay. So he was Ross Perot's running mate back 28 or 30 years ago. But he was also the senior ranking officer in the Hanoi Hilton during the Vietnam War, and he had a bunch of GIs under his command that were prisoners of war, and of course it was just horrific. They're tortured, and psychological torture, physical torture, starvation, and a lot of these men died while they were in captivity. And then finally the war ends, and only a small fraction of the men get out. And because Stockdale is the highest ranking officer, of course, the press go running to him and they say, so, what was it like? And only a small fraction of men made it out. What differentiated those men from the men who didn't survive? And Stockdale says, well, that's easy. The guys that didn't survive were the optimists. And everyone went, what? And what we learned is something that's now called the Stockdale paradox, and that is that the optimists are the ones that are the least able to deal with prolonged, serious downturns. And so that's the sort of thing where when you apply Kahneman's prospect theory, I worry that that could happen at some point. And some point could be in 2023. It might not be until 2033. But at some point, we've never really had a major, like what we saw in the 1930s, drawdown with a broad swath of society invested in the market. And so we don't really know how a broad societal reaction will actually play out if that's what we have. So forgive me for the interjection, but I wanted to make the point because I thought it was relevant to what you were saying.
No, it's really important, and it's a great analogy of risk and optimism. And I look, to your point, I am an optimist, and I think we need to be optimistic in life and in approaching things, but you also have to be realistic as well. And I think the realistic part of you has to, I'm a business owner and a business leader and entrepreneur, and as when I think about, call it understanding the different tiers of risk. And looking at, of course, the progressive opportunities, upside opportunities that we can, really attack and take advantage of. You also have to understand this, the sort of risks on the downside and how will you survive or manage through those. And I think applying that same principle to your portfolio is really important. So a great example, here's a great example of that. I think where people are maybe more optimistic is, let's say you get into retirement. Or you get into a portfolio that requires an income stream. Mm-hmm. And, you can build, a return stream that says, I need to make 5% a year or 4% a year off my portfolio. And that's great. And, you can get all your sources of returns, including capital gains and, interest income or dividends and everything like that. But what happens is that, like, when the markets are doing well and you're able to, comfortably take out 4 or 5% of your portfolio, it's really easy. When things and people manage to the averages, like, oh, the average return is going to generate 7%, so you'll be able to comfortably take that out. But the actual average return of the markets is never actually a real number. Like, I think out of 100 return streams, like, I think the average actually happens like once. The variance is that most of the times it's above the average or it's below the average. And so the reality is that in down periods, that plan can get tested. And if you are using capital as a source of your extraction when you need income, it becomes very, very difficult, both because you're impacting your long-term earnings capability of the portfolio, and as an individual, you're not only you're taking money out of the portfolio that's already down, and so you feel that. And so that what happens is most people don't spend it, or they stop spending, or whatever it be. And that's a really difficult thing for most people because, of course, they need that income. And then, by the way, this is the same with portfolios like trust portfolios or foundations and charitable income. And so where things are that they are actually extracting it, one of the things you realize is that portfolio needs to actually have a cash flow planning. And meaning that in good and bad markets, your only ability should be that what are you generating from cash flow? And that's the only thing you can extract. And if you extract capital on top of that, you actually have really, a pretty often scenario where you're going to get hurt badly. But that's why, applying these downside scenarios and where optimism is good to have upside expectations, but having a realism in terms of how you map out and have a more disciplined approach to portfolio constructions to the goals and needs of what you need from that capital. And, anybody who is in a, I need income now, and there are many things like that. Foundations are like this, and who pay out, charitable distributions. We see this all the time. If you are not monetizing that effectively, then you sort of have to ask yourself whether or not you've properly positioned the portfolio from optimistic perspective, or too optimistic.
So that is a beautiful segue to my question that I had, that I've been meaning to ask you for so long, which is about longevity risk. And that's something that I know is very near and dear to you. So we can't talk about products, but that's a major concern for people these days because people are living longer and all the things that you just mentioned. Um, can you tell me about how they work and why they're important?
Yeah, and if I could actually, before I get into it, can I just step back, and I want to, give some principles of the way, the human bias stuff came into the way we think, because it then leads to this. So, I made the comment that, Danny Kahneman was someone that you got a really good chance to spend time and understand how he applied his human biases to investment process and portfolio management, but more importantly, how, advisory should be done for someone who, doesn't need money. They're very wealthy, right? And also, broadly. And one of the things that was really important was that it came down to this idea of, when you're managing money, you're really not managing, returns. You're managing happiness. And, what that means is you're really focused on how do you help clients meet their actual goals. Clients don't care what the S&P 500 did last year. I know that people like to believe that they do, but the reality is clients don't care about that. What they care about is, I need a certain amount of return to meet my long-term goals. I need X dollars of income. I need X dollars of assets at the age of 65 or 60, or just so I can retire. These are the things, and what that is a much more precise, disciplined approach. And when you get into that type of thinking, one of the things you have to do, to your point, is you have to have an optimistic view that you're going to be able to generate those returns, but you also have to have a structured view of risk and risk management. And what I saw, in doing that, was that clients, and advisors, and investment managers like ourselves had to work together on a structured way of thinking of what's the purpose of a portfolio, pun intended, and how does the different components of the pieces of the portfolio work together to make sure that we have a higher probability on meeting those goals. And that goal could be a return requirement. It could mean an income retirement. And so that was the really principle between, when I sold Claymore and thought a lot about where the market was and what we had done. I said, I love what we did. We didn't spend enough time on the risk management and the process-driven return streams that give, a way to build more robust portfolios. And that's what we've been doing at Purpose.
So that's great. That's the sort of thing that I was talking about earlier. What Purpose has done is you solve problems. You think about things that are out there that other firms just put out Me Too products, and they say, well, this is the way people think. And then people don't lift their gaze far enough to say, well, what exactly are we trying to accomplish here, as opposed to, obviously firms that manufacture products are trying to gain market share, but they're looking at things in traditional ways. And it looks as though your approach, and I think mine as well, is that we're both maybe a little bit more out of the box thinkers, and that we're prepared to look at, say, well, okay, what are we trying to accomplish here? And then step back. Okay, well, does doing it the old way actually help to solve the problem, or do we need to look at this differently? And I think recognizing the asymmetric risks, recognizing the needs of people post work as opposed to when they're still accumulating assets, those are the sorts of things that are really, really critical. And of course, the behavioral biases that, to my mind, many people in the industry still don't. And I'm not trying to cast aspersions on the industry. I'm just saying I think we as an industry can all do better. And I think investors should be looking for people who are trying to solve problems as opposed to just people who are doing what they've always done. I think being a little more forward looking is useful.
That's exactly right. And frankly, what the word purpose came from was a bunch of different things, but one of them also meant that, like, the world doesn't need just another Me Too asset management firm or ETF company. Right. It needs someone who's going to come in and be relevant have a purpose in the industry to help advisors, help investors get to a better outcome. And that's what we established this company with, that mindset, which is let's go really help this industry be better. And I will say that we see it every day. Advisors think this way. Advisors are focused on, what am I trying to do for my customer? What does the customer actually need? And oftentimes they don't have all the tools. They don't have all the education on the, how to think through these things. And that's also what we can do, is help people think. We can think on their behalf, and help them and lead them. And we're very comfortable leading from the front of that. So let's pivot to this longevity risk pooling question you had, which is really important. So one of the things that's been on my mind a lot is that, if I go back 30 years ago, 40 years ago, one of the great things, about life was that you'd work for a company, you'd accumulate wealth, and then the company would offer you a defined benefit pension plan, right? You get this, and the word pension plan today gets called, like, diluted a little bit, but you had a real pension plan, which was that the company was investing on your behalf some of the income or from a savings perspective on your employment, and you would when you decided to retire, you would get a stream of income based on your retirement age and the amount of time you'd worked, whatever, for the rest of your life. And if you lived for 3 years or you lived for 50 years, you knew that you had an income stream coming in. And that is what they call the defined benefit pension plan. There are still, of course, many people in the world who still have them. And if you're a teacher in this country, if you're a municipal worker or a federal employee, you have them. But if you work for any corporation today, you pretty much don't have that benefit anymore. Over the last 35, 40 years, we saw most Canadians actually not be covered by a pension fund, a defined benefit pension fund. And rather, most corporations transition to what they call defined contribution, which is just a savings plan. It's not there's no income stream, there's no guaranteed or life income for life model. But what made pension funds, and by the way, it's the same thing why CPP works so well, why Ontario teachers work so well, or any of these municipal programs like OMERS and other things work so well, is that you're pooling people together. And the pension plan, or the company, the corporate plan, is effectively managing the risk of paying people once they retire their income stream for the rest of their life. And again, some people live for 3 years and some people live for 50, but the average person lives for, call it 23 years or 22 years after they, after 65. And this is use 65 as a retirement age, just for simple terms. And so, this is a really powerful technology. And what that pooling does is it allows the portfolio to manage a group of people who have a common need, which is income stream for life, and manage, all of the pool, because you can't say when one person is going to die, but you can say when an average of a pool is going to die, and that you can manage. And so it's a very powerful solution. And longevity pooling actually generates a couple hundred basis points, about 1 or 2% of additional return on a portfolio for the participants in the pool. Now, as we know, like outside of federal governments and municipal employees, very few Canadians have access to this anymore. And so, what we've seen from the academic world and the research and even the governments, they've been talking a lot more about how do we get more solutions that provide the benefit of income for life, not just income, like a balanced portfolio that gives you 4%, but income that is designed to actually pay you for no matter how long you live. And this issue has become much more prevalent. And, what we've seen today is a lot more focus on how can that be done for the broader masses. And purpose, we launched the Longevity Pension Fund, which was the first of its kind to bring this to the masses. It was the first of its kind in the world. And it's gotten a lot of accolades on a global basis from, pension experts and academics around what we've done, which is taking the technology and infrastructure that you would normally have in a pension environment and bringing that into a mutual fund for the masses. And that's a really powerful thing. And so we think it's a really critical component of solving for the foundational components of retirement, or we call it where do I generate income in a post-work environment of my life.
I think that's a great way of demonstrating purpose. In terms of actually just saying, you're not just doing something, you're doing something for a clear, well-defined, specific reason that hadn't been addressed previously. And that's a wonderful, wonderful way of summarizing. Good. Som, thank you so much. That's all we have time for. It's such a pleasure speaking with you. You're such a wealth of information, and I love your perspective. I love the fact that you're the sort of person who gets the industry thinking out of the box and moves the ball forward. I think, it's a real testament to you and to the people at Purpose that the world is a better place because there are people like you out there trying to find ways to build better products to solve problems that real people have. And it's just a pleasure knowing you. And I want to thank you so much for appearing on the podcast today.
Well, John, I just say thank you for the kind remarks. And I just say the same. I've known you for a long time. I've watched the way you've talked and been an advocate for really better practices within the industry. And I'd say kudos to you for continuing to be a great advocate for better outcomes for customers and for individuals and, Canadians as a whole. And I think it's great to see people really talking about how can we be better as an industry. I think our industry sometimes has bad parts to it, but it's such an important industry for customers. Customers do better when they're advised with great advisors. So
I think that's a great way to end it. A lot of what I talk about in Bullshift and in the previous book, Stand Up, is just trying to stand up for the industry precisely in order to see if we can get better outcomes, because we all want the industry to do better. Som, thank you so much. We'll see you soon.
Bullshift, the podcast, was created in support of John DeGui's book, Bullshift, available now online and in bookstores everywhere. The comments and opinions are those of the author and his guests. They are for informational purposes and should not be construed as investment advice. John DeGui is an author, public speaker, senior investment advisor, and portfolio manager at Wellington Altus Private Wealth. For more information about John and his books, please visit standup.today. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.